Welcome to Wealth Coffee Chats, folks, for your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes, and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Hey, good morning, folks.
Good morning, everybody. Welcome to another Wealth Coffee Chat.
Hope you're well, folks, wherever you are.
There it is, team. Morning. Morning, wherever you're tuning in from today.
Early bird gets the worm, they say. Here at Positive, we offer a 6-star team. It's a team that help you at every stage of your wealth creation journey.
Good morning, everyone. Welcome back to another Wealth Coffee Chat. I'm Daniel MacPherson from the tax team, and today we're going to talk to you about one of the most misunderstood and sometimes most expensive parts of property investing, and that's GST. So I know you're probably thinking GST is just something that businesses have to deal with, but the thing is, if you're selling new property, subdividing land, buying a commercial property, GST is sitting there in the background waiting to take a bite out of your profit. And if you don't plan for it, that buy can turn in what to look like a good deal at the start into a nasty surprise at the end. So today we're going to make GST simple. We'll look at when GST applies and when it doesn't, the magic of the margin scheme and why it can save you a heap of money, the rules that buyers paying GST straight to the O at settlement, how commercial property works, including the powerful going concern exemption, and finally the classic GST mistakes that cost investors thousands of dollars. All right, so first up, I guess, when does GST even apply? So the ATO says GST applies when you're carrying on an enterprise. So that's really, I guess, accountant speak for running a business. But the trap is you don't have to be a massive developer building 50 down houses to get caught up in this. So even a single project can be classified as an enterprise if your main goal was to make a profit. So if you sell new residential property, meaning something built in the last 5 years that's never been lived in, you're in GST land. And if you're subdividing a block of land and sell the lot with intent to make money, you're likely also in GST land as well. But if you're just selling off an old family home that you've owned for years, or maybe doing a one-off capital realisation like chopping off the back block to pay down the mortgage, there may not be GST applicable in that scenario. But where it does bite, though, is if you do it more than once, bringing in contractors, advertising, suddenly the ATO kind of says, mate, you're a property developer, and GST now applies. So you need to know which side of the line that you're on before you start spending the money. I have done an episode on backyard development, so do jump on and have a listen to that, as it does go into a bit more detail from that point of view. All right, so let's talk about one of my favorite planning tools, and that's the margin scheme. So under the normal rules, you pay 1/11th of the sale price in GST. So if you were to sell a brand new townhouse for 1.1 million, 100 grand goes straight to the ATO. So I guess just to clarify, this is for brand new residential. We're talking now if you were to do a small development. But under the margin scheme, the GST is on the margin. So the difference between what you bought it for and what you sold it for. So if you picture buying a block for 400,000, build a duplex, sell one side for 900. Under the normal rules, you'd owe about 81K in GST. But on the margin scheme, you'd only pay GST on that $500,000 margin, so about 45,000. So that's kind of like 36 grand that you're getting straight back in your pocket just because you ticked the right box and had the right clause in the contract. But, and this is an important but, you can only use the margin scheme if you bought from someone who wasn't charging GST or they also sold on the margin schemes, and you must agree in writing before settlement. So really important to, before you sign the contract, have the conversation with your lawyer and accountant. It's not sort of like an, oh, we'll sort it out at tax time conversation. You really do need to get it right at the time. Now, also a quick one here. Since 2018, buyers of new residential property have to withhold GST and send it straight to the ATO at settlement. So this does mean that you never actually see the cash in your account. So they've removed the temptation to spend it, which seemed to be happening for a few developers that would then throw the company under. But it also means, I guess, no nasty surprises later. So you still lodge your BAS, but the credit is already applied. And yes, you must give the buyer a written notice saying whether GST applies. So don't skip that step because there are penalties that just aren't worth it. Okay, let's switch gears into commercial property because this is where investors can get burned or win. If you own commercial property and lease it out, you're normally charging GST on the rent. I mean, that's kind of a good thing because then you also get to claim the GST credits on the expenses. But the big one is when you buy a commercial property with a tenant in place, you can potentially use the going concern exemption, which means that there is no GST payable at settlement. Now, this is pretty big. So I think if you've got like a $1 million property and you had to pay 10% GST, so you need to stump up that other 100 grand at settlement and then wait potentially sort of like 3 months until you can claim that back on your BAS. So it can be a bit of a nightmare from a cash flow point of view. And lenders don't always are keen to give you that extra 10% either. So the going concern exemption fixes that. The conditions are fairly simple. The lease must continue right up until settlement, and the contract has to say that it's being sold as a going concern. So miss either of those, and GST applies in full. Now, when you sell commercial property, using the going concern exemption can make the property more attractive because I guess as you're buying, other buyers like to avoid that GST hit, and that usually means they'll pay a little bit of a premium as well. But if you're buying vacant commercial property, GST is most likely going to apply. But if you're registered and plan to lease it out, you can claim it back. It's just really making sure that you've got the cash flow and that extra 10% of funds to cover until that refund does come through. So this is why GST isn't something you think about just at tax time. It's something you need to plan before you even buy the property. You do need to build GST into your feasibility model from day one if you're doing a development or a subdivision. Know whether you'll need to be registered, whether the margin scheme can apply, and whether the buyer is going to have to withhold at settlement. So structures matter too. We won't go into that today, but using the right trust or company can keep GST credits flowing and avoid cash flow headaches. You can get sort of those contract clauses right, making sure that you've got the margin scheme and going concern agreements in place. So make sure you chat to your accountant and solicitor about that and get that sorted well before settlement. Now, some of the, I guess, more common mistakes that I see are, number one, people not registering for GST before their taxable sale and missing out on input credits that they could have claimed. Number two, thinking GST doesn't apply because it's just one deal. The ATO doesn't really care about intention the ATO only cares about intention and pattern, not whether you have a business card that says developer. And number three is forgetting to elect the margin scheme and paying way too much GST. And also in commercial property, buying without checking whether the actual going concern condition applies, and then having to sort of scramble last minute to find that extra 10% of settlement. Not a fun conversation with your lender or your accountant for that matter. So there you go, team. GST on property in a nutshell. I guess the takeaway is GST is not the enemy, but it will eat your lunch if you ignore it. So plan ahead, use the margin scheme if you can, take advantage of going concern on commercial property, and make sure you get the paperwork right before you sign. So as always, if you're planning a subdivision, a duplex build, or looking at commercial property, make sure you chat with your accountant before you sign on the dotted line. We'll run the numbers, check whether GST applies, and make sure you're keeping as most of the profit as possible. All right, everyone, that's your Wealth Coffee Chat for today. Have a good one and talk to you soon. See ya.
Thanks for watching another episode of Wealth Coffee Chat, folks. Make sure you like, subscribe, and turn on your notifications so you never miss a thing when we go live. Improve your portfolio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes are also available wherever you get your podcasts, folks, as well as our other podcasts from the 6-Star team here at positivementor.com.au.